Let me ask you a question. What's one of the biggest reasons why people have decided not to purchase real estate in the current market? Well, you guessed it, it's their monthly mortgage payment. Now, this is obviously true in a primary home market, but I feel like this reason is even more true in a secondary or an investment market like the Outer Banks, where rental income is such a significant reason of why people decide to purchase real estate. Obviously, if the rental income ratio to home ownership expense is simply unattractive, it's a reason people haven't moved forward with buying real estate the past 2 or 3 years. So let's talk about some solutions I've seen in the past of how people have managed their payments. The first one's pretty obvious. It's not super helpful for me, but if you borrow less money, it's a way to make the payment more manageable. It's just simply bringing a larger down payment when getting a mortgage. Another solution people have come up with is, paying points either themselves or negotiating where a builder or a seller would pay for closing costs for them to eventually, of course, get a lower rate and a lower mortgage payment. And I've helped clients obtain a rate in the mid to low sixes, which is obviously more attractive than 7%, which is typically what we see on the media. But today I wanted to talk about some buy down options because this gives us the opportunity to offer rates in the mid fours to mid fives. And I believe if we can have rates in this range, people's mortgage payments would be much more manageable. So let's take a few minutes here and look at some different options we can offer.
Let's just first talk about how I looked up some of these mortgage rates or mortgage payments. You can simply just type in on Google mortgage calculator, go to this calculator and manipulate any scenario that you want to see. So you can just hit update and it'll calculate the principal and interest for you right there. Nice and simple. So when it comes to the scenario of how we can get lower rates, obviously it involves negotiating with the seller. The seller has to basically agree to some type of seller credit or a price reduction. So these are sellers that are a little bit more motivated for these scenarios. So when we look at a scenario, I try to use just kind of a middle number of $800,000 as a purchase price. And before I go any further, let me first just mention that the most important criteria for some of these terms I'm suggesting, they're really just examples. Again, I'm not quoting a rate here. But for these examples, some of the biggest factors are the down payment amount. Down payment can make a pretty big difference on what the rate we can offer you as a lender. And of course, your credit score is another big determining factor of the rate we can offer you. Lastly, another determining factor of how we can save you money in these scenarios is how much money you're borrowing. Obviously, if you're borrowing more money, you can save more money on interest and therefore also have a lower payment. So using this middle ground number of a $800,000 purchase price for our market on the Outer Banks in North Carolina is a fairly median home sales price that you might see, but there's definitely substantially larger sales prices. So we're going to kind of do a comparative of the two. So when we look at the $800,000 purchase price, let's assume we're putting 20% down or we're borrowing $640,000. I'm going to use closing costs as a constant. Closing costs, of course, varies with different attorneys, insurance, and other things. But just to use kind of a constant number to make this example a little bit easier, we're just going to use $12,000. And after we do our simple math of $160,000 plus $12,000, our cash to close is $172,000. And then we have our principal and interest payment. And I just use an example rate of 6.75%. I didn't include the taxes and insurance because that's just really not our focus. But let's just give an example of if a seller reduced their price by $40,000. What does this really do for the buyer? If they're this scenario of 20% down. Well, we can go through this math with our 20% down scenario. We can see that one, it reduces their cash to close by $8,000. That's a result from it. And then another result from it is it lowers their payment by $207. A big factor for why people make the decision to purchase in our market is due to rental income. And obviously for home ownership expense due to rental income ratio. It's really specific per property. And of course, our rents being seasonal or in the summer is another, variance of what bookings are going to be that year. It's not a constant. And so I'm not really here to speak on rental income heavily. I'm just here really to speak on the differences of a price reduction versus a seller credit or a combination. So let's look at, instead of this time, a simple price reduction of $40,000, let's look at kind of splitting the difference. If we essentially bought the rate down to 6.125%, and this costs roughly about $16,000 in points, and then additionally, I have $12,000 in closing costs. Well, obviously, my total closing cost in this scenario is $28,000 for this lower rate versus the 6.75% rate over here. And so when we get over to our price, we want to reduce the price by $12,000 because we've only used $28,000 for the points and the closing costs. So we reduce the price by $12,000, and then we get a purchase price of $788,000, and we have our seller credit of $28,000. So when we go through this scenario, we can see that all the closing costs is paid for, and so that brings our cash to close to be $6,400 less than the 5% straight up price reduction, or $14,400 less than the original purchase price. So it's still a decent amount of savings. I just want to point that out. It's not a life-changing amount of savings, but saving a couple $1,000s never hurts to make the scenario more attractive. And then we get a principal and interest payment, 6.75 to 6.125 is 5/8 or 0.625 difference in a rate. And so you can see here that compared to the price reduction, we still have a lower payment. Again, it's not necessarily life-changing, but it's $113 lower compared to the other scenario where it was just the regular $800,000 original purchase price. It saves you $320.65 a payment. So it's a decent amount of savings, but I'd rather see a more impactful, or I feel like for purchases to happen on the Outer Banks more often, that we need a more impactful payment scenario to help buyers make that decision and help sellers create really an attractive scenario. I just think one of the things that I would be thinking if I'm a seller is, how can I get in the mind of my buyer? Whether it's the location of my property or what amenities might be close to it, or whether that's rental income. How much money would my buyer be willing to put down? Is it going to be a 1031 exchange? Do you think it's going to be a primary home buyer? I think that's something to really think about before we just make a decision on a list price or a scenario of a mortgage scenario of what someone might receive. So I think those are really important questions to kind of think about if you are having a listing that's 120 days or older, that's in this price range. You might want to give me a call or consult me on what I think could be an attractive offer. I do want to look at, what if the purchase price was a little bit higher? Let's use a $1.4 million purchase price example, because one of my main points is it really makes a difference on how much money is borrowed for this suggestion that I'm making. And I know I'm going to eventually get to the conversation of a rate of rates in the 4.5% and 5.5% range, like I mentioned earlier, but I just first need to go through kind of the mentality or the thought process of, for agents and sellers, what's more impactful for people? Is a price reduction of 5% more impactful? Is splitting the difference, like I just showed, more impactful? It's just something to consider. So let's look at a higher purchase price for a minute here. Take a second to get it on my screen. Okay, so when we're looking at the higher purchase price, this time I'm going to use an ARM product instead of a 30-year fixed. We're in the jumbo space. In this circumstance, we're putting down 25% instead of 20. Of course, you could do 20% in this example, a 1.4 million purchase price. I just thought that a lot of times from the bigger priced home or the higher priced homes that people typically want to put a little bit more money down, mainly for cash flow purposes. If you watched my 1031 exchange interview, you'll see that I made a point to Stuart, for example, my client, to say that I really felt like 30% down was the right way to go for cash flow purposes. And he originally didn't have the same number, but eventually when he got more concrete about his 1031 exchange, he ended up putting a little bit more money down. And so that's one of the reasons why, is really for cash flow purposes. But my main point here is we have our cash to close, we have our mortgage payment, and then we have what if we reduce our price by 5% again, which is $70,000. So when we reduce our price by 5%, we can see that we lowered the payment by $336, and it was a $17,500 lower cash to close. But what's this do if we do a split like we did last time, where we did a reduction in price and then we also did a seller credit, and we're using an ARM? Now, obviously, this ARM rate is already a little bit better than what I was quoting on a 30-year fixed, but let's see what 2.5 points buys us with a ARM rate for this jumbo product. So 2.5 points essentially buys us, which it cost about $26,000 to get to a rate of 5.5%, which is 2.5 points roughly. Again, it's not exactly to a T, but this is a rough idea, and it's really just to provide the example. So if I can say that my $26,000 is going to points, then I'll have, in this example, $20,000 is my closing cost constant, and so that's $46,000 in a credit. So that's what I'm showing here, is a $46,000 seller credit. And then once I've determined that, I just take my $70,000, which is my original price reduction, minus the $46,000, and we give a $24,000 price reduction. So I minus the $24,000. That's how I got this number. Then we did 25% down. Closing cost is paid by the seller. This saves you about $8,500. Again, not necessarily a life-changing amount of money, but it is a little money saved. Doesn't hurt to have a couple $1,000s saved. Same thing compared to the original price, saves you about $26,000. Here's where the biggest kicker is, in my opinion. And this is, Stuart, for example, utilized this strategy and it really benefited him. In this example, this ARM scenario, you can get this rate of 5.5% compared to the 5% price reduction. It still saves you $527 more in a payment. And that's a pretty significant difference. Obviously, within a year, that's over $6,000. So a pretty significant difference there every year in cash flow compared to the other, without the price reduction or the original scenario. It's an $864 difference lower in a payment. And then once we've gotten to this point, which obviously we can see this is the most attractive scenario, when you basically borrow around $1 million, it really starts to become more obvious that the seller paying for a lower rate is just frankly more attractive, whether you're in an ARM or 30-year fixed in this $1 million loan space. You can do it in either one.
But also on top of the scenario, a 30-year fixed with a smaller sales price or the jumbo ARM, for both scenarios, we offer temporary rate buydowns. And this is how we can really offer rates in the mid fives or in the mid fours, is with temporary rate buydowns. Now, there's a lot of different terminology used very quickly, but there are different temporary rate buydowns. For example, you can do a rate buydown with just a 1-year rate buydown, where, as an example, if your rate was 6.5%, like shown here, you'd have a temporary buydown for the first year of 12 payments, where your rate would be 5.5%, and then the next year it would move to 6.5%. And I personally think this is a great opportunity for property on the Outer Banks, where we're likely going to need a remodel. The house may be rented for a year or two, but eventually the goal is to pay off the original mortgage and eventually remodel the home
And this could be a great solution for having a payment temporarily lower for the first year or two, and then doing the remodel. And it's a great way for you to control the payment and obtain really a more attractive cash flow for the property. So there's also, like we showed here, there's you can lower your rate with a 2-year buy down, or you can lower your rate even more with a 3-year buy down. And again, this is the case for the $800,000 sales price scenario. That's a 30-year fixed. You can do a temporary rate buy down like shown here, or you can do it with the jumbo arm. I think it's worth mentioning that if we're in the smaller sales price range and just borrowing simply less money, we really need 2 to 3% rate improvement for the payment to be substantially lower. And so if you do the temporary buy downs, you can expect, depending on the program you choose and the parameters, it's somewhere between $250 to $500 lower a payment, depending on the parameters and other items. So if you're interested or really believe that rates are going to drop, the 1-year, 2-year, or 3-year temporary buy down options can be really attractive. And just to speak on, rates for a second here, I think one thing to mention about about markets in general is that there's definitely a difference in the market as far as housing goes and sentiment in 2025 compared to 2024. However, rates really have not changed. They're really around the 6.5% to 7% range for a primary home. And that's the way they've been really since last November in 2024. And I believe that because we're getting a different sentiment in the market over the past 2 or 3 months, it's very likely that we're going to have a different rate opportunity here in the next 8 to 12 months. So you never know. It is just my intuition that I'm following on here. But I think it's worth mentioning that 2025, if you ask most people that are in real estate, really feels like a different market. And one other point I think that's worth mentioning for the temporary rate buy downs is that in metropolitan markets, they're not offering a 5% price reduction or seller credit typically. If you look at most of the listings that are in these metropolitan where they're building a very similar home multiple times in a community, they typically offer anywhere between $10,000 and $20,000 for a closing cost credit for these type of temporary rate buy downs. And in these scenarios, we're talking about a 5% really price reduction or seller credit used to make the payment and cash to close more attractive. And it's a great way for the temporary rate buy down where sellers don't have to lower their price so much, but the buyer still gets an attractive payment, especially if rates do drop. The refinance on the temporary buy down, there are variables, but it does allow for an opportunity for the refinance to be at no cost. So that's another point that's worth mentioning. I hope you enjoyed this newsletter and found it helpful. Please like and subscribe this video. If you would like to see more information about the temporary rate buy down, I'm happy to show you and talk about it, but just limited time for today. And we'll talk to you next week.